So he bought at the beginning of the cycle, right? He bought at the right time. Don't have a hard and fast principle that you're going to avoid high supply areas. So essentially, it had about 33% growth in about 10 years. So very poor growth over that 10-year period. Don't again get caught up in this hype of interest rates are getting cut. I gotta get in early and you've heard this advice, never buy new properties. Property doubles every 7 to 10 years and rate cuts will boom the market overnight. So the truth is, in 2025, if you follow these principles blindly, you might lose thousands of dollars. So let's break down what's real, what's outdated, and how to actually make better moves this year so that you can make money investing in property in 2025. Hi, for those of you who don't know me, my name is Jadu Srikandan. I'm a buyer's agent for property investors and I buy properties all around the country using a data-driven approach. So if you want to work with me, then go to my website propertyframework buyersagency.com.au and book a session with me there. In this video, I'm going to break down 5 myths, but more importantly, I'm going to show you what works instead in 2025. So what we'll cover in this video is how these myths trip people up in the 2025 economy, specific examples, suburbs, trends, and so on. Practical tips like you can do this instead, and this is what is going to work, where you will know what you need to do instead. So as you see real examples, live data, and my take on what to do if you want to invest smart this year. Let's go to myth number 1, and that is avoid high supply areas. Don't buy new properties. I'm not a big fan of new properties either. I prefer older houses on big blocks of land, properties that you can add value to. That's the typical property that I would buy. But that doesn't mean that if you buy a new property in an area where there's high supply, that is the end of your property investing journey. No. And that's why I want to give you a very specific example. So I was speaking to a prospect recently and he bought in 2020 or 21, he bought a property in the suburb of Flagstone in the Logan region. Now I'm just going to show you where Flagstone is located. So you can see here, Flagstone is this suburb in the Logan region. Here you have most of these suburbs in Logan like Woodridge, Slacks Creek, Marsden, Crestmead, and so on. And Flagstone is one of these suburbs around here, right? And you can see there's plenty of developable land supply around this region. I'm just going to show a heat map which shows the extent of new properties coming into this area. Flagstone is just around here. The red indicates new land supply. Okay, so you can see there's a lot of new land releases just coming around Flagstone, right? So you have Flagstone, Jimboomba, all those areas where there's new and more new properties coming in. There's Logan Village around here. So all of them are areas where there's a lot of house and land packages coming up, high supply area, right? So this prospect who spoke to me, he said he bought a property in the Flagstone region for around $450,000. He built a house on a land, right? And now the property is worth around $750 in a matter of 4 to 5 years. So the property has done well, right? So it's a growth of around 60-70% over a very short time frame. You can see that despite having high land supply, the property has done well. So what was the reason for that? So if we go back and look at the trends in Flagstone, so this is the Flagstone price growth, you can see that it was pretty much stagnant until 2020. 2021 was when the cycle was really picking up. And so he bought at the beginning of the cycle, right? He bought at the right time. He bought in a high supply area, but he bought at the right time when the greater Logan or the greater Brisbane region was just about to start a new fresh cycle. And in fact, the market was booming. Conditions in that area were good. Flagstone, there was a high demand, low supply, and tightening market conditions. So property values just shot up really rapidly. So as long as you can get into the correct market at the correct time and buy in kind of established pockets, even in these high supply areas, then you minimize the risk and you still get growth coming through, as in this example. I had someone else who spoke to me and they had bought a property in Truganina in the Melbourne region in 2022. So just to give you some context, this is Truganina here in Melbourne. So you can see there's a lot of land supply just around. This is the the Melbourne CBD area. Lots of new house and land packages, new supply coming into this market. They bought in 2022 and the property was stagnant for about 3 years. Now, the reason for stagnation was not high supply in particular. The reason for stagnation was because the Melbourne market, the greater Melbourne market as a whole, was going through a very sluggish period between 22 and 25. And so when they said, oh, I brought in Truganina, it's a very high supply market, and that's why my property values did not go up, that statement was actually incorrect. The property value did not go up because the Melbourne market as a whole was stagnating during that time frame. They bought at the wrong point in the cycle. What do we kind of take away from this? I think if you're buying in 2025, if you're going to buy in higher supply areas, then we don't want to go into markets that are late in the growth cycle. For example, markets like Alkimos in the north of Perth, northern suburbs of Adelaide, for example, the Playford area where there's a lot of supply. And then, of course, the Logan Ipswich region where there's plenty of supply around that Ripley and these Logan Village kind of areas. We don't want to buy there now because we are late into the cycle. Vacancy rates have moved up. The high supply is now going to restrict growth moving into the future. But we can look at markets that are earlier in the cycle. So even though there is high supply there, the market will still accelerate forwards because the conditions are correct. We are early in the cycle. And an example would be the Melton region in Melbourne. High supply, but I'm already starting to see that shift happening. 500,000 properties are not going to remain at 500,000 in the next 3-4 years. More likely, they will be 750,000. So the key is, okay, you can still buy in high supply areas, but look at established pockets, look at suburbs with lower vacancy rates, and try to minimize that risk as much as possible. Don't have a hard and fast principle that you're going to avoid high supply areas because you could be leaving money on the table. Okay, so that's point number 1. Let's move to the second one, and that is property doubles every 7 to 10 years. Now, this is a very common saying, like people have used it in the past. You know, let's say you buy a property for 500,000. In 10 years, this property is going to be 1 million. But how did you know that? How do you know this would happen? Let me share an example with you. This is Brisbane. So I've taken, this is data from Hashtag showing the data for the northern suburbs of Brisbane. So let's have a look at that. Okay, so from here, I can see that this is all the suburbs in the north of Brisbane. Around 2010, prices were sitting around 600,000. And in 2020, it was around 775,000. So essentially, it had about 33% growth in about 10 years. So very poor growth over that 10-year period. Now let's look at Adelaide. So I'm looking at the city of Salisbury in the northern suburbs of Adelaide. I can see here over a 10-year period, 312,000 median price in 2010, median price in 2020 is 352. So hardly any growth. So it's not correct to say that property will double in value every 10 years. So if, for example, if you go into a market like, let's take the same example, so Salisbury. So median prices now are sitting around 684,000. So close to 700,000 is the median price. So property values have pretty much doubled over a 5-year time frame. So you can see 92% growth here. So if you go to this market and buy a 600,000 property, statistically, there's very less chances of this market becoming 1.2 million in the next 7 years or so, because it's kind of reached a point where affordability is getting stretched and it's just hard for the locals in the area to manage mortgage repayments. Don't go blindly by the principle, okay, as long as I buy in a good market, my property is going to double in the next 7 to 10 years. Instead, look at the underlying factors. Look at how much growth this market has had in the short term, next 3 to 5 years, for example. Has it had a lot of growth? Has it had less growth? How are the conditions in this market looking like? Do you see a lot of people putting offers on properties? Is the stock starting to lower down? Is the rental demand tightening? Look for these factors and then decide your investment option. Don't blindly go by this thesis that property would double every 10 years because you could end up selecting the wrong market. All right. Now let's move to point number 3. This is the point that capital growth is the only thing that matters. And yes, it is a very, very important aspect of property investing. Capital growth is really important, but not at the expense of cash flow. So let's say you are a first-time investor. Your income is moderate, it's not super high, and you want to build out a portfolio. To have a portfolio, to build out your portfolio, what you need is good capital growth and at the same time, good rental income as well. So if you buy a very highly negatively geared property, for example, everyone's talking about Frankston in Melbourne. So if you get caught up with the hype, and for example, let's say you buy a $800,000 property in Frankston that may rent out for about $500 or $550 per week, you would be negatively geared by $20,000 per annum. So two things would happen there. One, your borrowing capacity for the next purchase is already impacted. Number two, can you really afford a 20,000 negative cash flow property year after year? Of course, it will improve over time, but you can see it's a very highly negatively geared property. So rather than thinking capital growth is all that matters, how am I going to get to my next property? I'm going to build a portfolio. Yes, I want capital growth, but I also want my rental yields to be there so that the banks would look at me favorably and I can buy more properties. So it really depends on which stage you are in your investment journey. And if you're a beginner investor or someone just starting out, then you'll have to make sure that you get this correct, because otherwise that can slow down how fast you build your portfolio. So in this particular example, instead of looking at Frankston, the investor may choose to buy a property for $500,000, maybe with a 5% rental yield, which might be the best option for him. For another high-income investor, maybe the Frankston option could be a better choice. So you can see here, it really depends on where you are at in your investing journey and what you're trying to achieve. So don't go blindly. As long as I get capital growth, I can ignore everything. You need to be very specific about your particular situation. Now, let's go to the point number 4, and I think this is a very important one. And this is the fact that, and it's a big myth, that interest rate cuts means there's going to be a boom everywhere in Australia. Rate cuts are going to impact certain markets much more significantly than others. And I think where the rate cuts would play a part here is in markets like New South Wales, Victoria, and even Tasmania to some extent. In these markets, we're not going to see a property boom. We would see growth. So don't get me wrong, we're going to see growth, but not a property boom. So when I refer to a property boom, I'm referring to Perth-like conditions in 21-22. That was when affordability was so strong, rental yields were so high, the market did not have any growth for a long period of time, and it had no choice but to go at 25% per annum the next few years. So really rapid growth because of pent-up demand and lack of supply. So that's what I call a boom. Now here, what we're going to see now with the interest rate cuts isn't necessarily boom-like conditions. We're going to see growth, yes, but at a much slower rate, because these markets in New South Wales, Victoria, Tasmania, they're starting what we call a second wind. They've had growth between 2015 till about 2022. Then they corrected between 22 to 25, and now they're starting a growth wave again. So when we have a second wind, the level of growth and the duration is usually lower than that initial rapid growth we had earlier. So yes, we are seeing growth, but don't expect boom-like conditions like 25-30% growth per annum in these markets, in these Victorian and New South Wales markets. So the key is when the media says interest rate cuts, boom everywhere, don't get FOMO and just buy a property anywhere in Australia. You have to be very specific of which parts you want to buy. Look for diversified economies. Look where the market is changing fast, where the stock is dropping fast, where the demand is increasing. It comes back to the basic principles of property investing, right? So don't, again, get caught up in this hype of interest rates are getting cut. I got to get in early and there's going to be a boom. I'm going to miss out on the biggest boom ever. That's just hype, and don't fall for it. Let's go for the last point. And this is, you can build a big portfolio on a low income. I know this is kind of a marketing strategy that's being used. I've got only a small income, but look at how many properties I had. In fact, I was just talking to someone the other day, and they said, how do these people build these big portfolios? Is income a factor? And then I gave this explanation to them. So yes, income is a huge factor. And the reason is, You just can't build a big portfolio without increasing your income gradually. So what I mean by that is a property today, like I mentioned earlier, even a 500,000 property renting out at 5% rental yields is going to be negatively geared by $10,000 per annum. So even if you go and use advanced structures like trusts and are able to buy more properties, even with tighter, your tightened borrowing capacities, you'll find that at some point you just can't afford to hold all these negatively geared properties. You are 10,000 per annum. Let's say you buy 3 of them. You're already negatively geared by 30,000 per annum. And that's something that a normal person would find stressful, right? 30,000 per annum going out from the properties is going to be stressful to manage. So unless your income rises to match that, you're going to struggle to hold on to these properties, and property investing becomes really difficult. As a beginner investor, I'm not discouraging you here. What I'm saying is, yes, you can start off on a lower income. You can buy a good, cheaper property that has all the fundamentals and moving up in value. But if you're looking to build a portfolio, then you got to do 2 things. You have to make sure that your income is rising gradually, and you also have to make sure that you're buying in the correct structures. You just can't buy in your own names, build out a portfolio that way in 2025. So you'll have to do both of this. Increase your income, buy in the correct structures, and buy in the correct markets each time, because you just can't afford to make a mistake when you're starting out again. I think these were some of the very common stuff that I've been seeing and hearing, and I thought I'll just do a video explaining about all this. So if you want to see my other videos, I've done videos on how to select growth markets, how to analyze properties, what factors you need to look into to find good growth markets. So go back and check those videos, because it'll give you an understanding of where you need to look, how you need to invest to beat the Australian averages. So hope you found this video useful, and I'll come back next week with another video. Until then, it's goodbye from me.